On May 2nd, during Apple's second quarter earnings call, the company announced a massive 110 billion share buyback, the largest in U.S. history.
Line for Apple, plus the largest buyback in corporate history. And as for that buyback, $110 billion. Like I said, that's the largest ever announced. That's according to Birani Associates. And then a dividend.
But Apple isn't alone in this trend. In the fourth quarter of 2023, U.S. companies repurchased $219 billion worth of their own shares, up 18% from the previous quarter. Major players like Alphabet, RTX, and Meta are also heavily investing in buybacks, despite Congress slapping them with a 1% tax in 2023. Why are stock buybacks so popular? How does it even work? Why does a company repurchase their own shares? What does it mean to us investors? Is there any hidden problem behind it? In today's video, let's talk about stock buyback. The main financial goal for any business, private or public, is to generate net earnings. For public companies, management has to decide how to use these profits. They have a few options: paying off debt, reinvesting in the business, hiring more talent, giving employees pay rises, expanding operations, or developing new products. As investors, we want to see the company grow, but it's also nice to get some of that excess cash back. And this can happen in two main ways: through dividend payouts or stock buybacks. A dividend payout is a fixed cash payment per share. A stock buyback, on the other hand, is when a company buys back some of its shares from the existing shareholders. This reduces the total number of shares on the market, meaning the company's profit is spread across fewer shares, potentially making each remaining share more valuable. This often leads to a rise in share prices following a buyback announcement. Interestingly, stock buybacks were illegal in the US for much of the 20th century because they were seen as a form of stock market manipulation. However, now they are a common way for companies to invest in themselves while putting money back into shareholders' pockets. There are 5 main types of share repurchases. Fixed price tender offer. The company offers to buy shares at a specific price, usually above the market rate, within a certain time frame. Dutch auction tender offer. Shareholders state the price at which they are willing to sell their shares within a given range, and the company selects the lowest price that allowed it to buy the desired number of shares. Open market share repurchases. The company buys shares on the open market at current market prices. This method is the most flexible and common in the US since the early 1980s. Transferable put right distribution. Shareholders receive put options allowing them to sell shares back to the company at a predetermined price. Targeted stock repurchases. The company buys shares directly from a specific shareholder or group of shareholders, often at a negotiated price. In the US, open market share repurchases have become dominant among all repurchasing mechanisms since the early 1980s. This method has a couple of benefits compared to other stock repurchase methods. First, the offer price under this method does not require a premium above the stock's current market price. Second, this method is more flexible in terms of timing, as repurchases can be spread over to 2 to 3 years, and there's no obligation to fully or partially complete an announced buyback. Ever since the US allowed stock repurchases in 1982, companies have increasingly favored buybacks over dividends. By the late 2010s, only about half of US companies paid dividends, compared to 78% in 1980. Between 2003 and 2012, companies in the S&P 500 spent 54% of their earnings on buybacks, amounting to $2.4 trillion and 37% on dividends. The trend has continued to grow. In 2022, share buybacks reached a record $1.31 trillion, a 22% increase from the previous year. In Australia, ASX 200 companies have spent over 36 billion Australian dollars on buybacks in the last 3 years. Major banks representing 18% of the ASX 200 by market cap have been responsible for over 50% of these buybacks since 2021. Do I have to sell my shares in a buyback as a shareholder? No. The company can't force you to do so. Since the company can't force you to sell back to them, a shareholder has 2 choices. Number 1, not participating, so you just do nothing and continue holding your shares. You still benefit from the buyback As the company repurchases shares, the number of shares on the market decreases, potentially increasing the value of your remaining shares. And this means you benefit from the increased share value without selling your shares. Additionally, any tax on unrealized capital gains is deferred until you decide to sell your shares in the future. Obviously, you can participate by selling your shares back to the company at the offered price. You might receive a premium for your shares, resulting in a potential capital gain or loss based on the difference between your purchase cost and the selling price. If you realize a capital gain, you need to declare it on the tax return. If you incur a capital loss, you can carry it forward to offset other capital gains. I'll elaborate more on the tax consequences of dividends and stock buyback so that we, as shareholders, can decide when to opt in. Bear with me. There are many reasons why companies love repurchasing shares. Number one, it demonstrates confidence in the company's prospects. When a company announces a stock buyback, it signals to investors that it has excess cash and confidence in its future. This action implies that the company believes returning cash to shareholders is a better use of funds than reinvesting in new projects. Additionally, reducing the number of shares outstanding can increase the remaining shareholders' ownership, giving the company more control. Number two, companies may buy back shares when they believe their stock is undervalued. This action can help normalize or increase the share price. However, this is not always guaranteed. Overpaying for shares or using debt to finance the buyback can harm the company's financial health. As Warren Buffett explains, the math isn't complicated. When the share count goes down, your interest in your many businesses goes up. Every small bit helps if repurchases are made at value-accretive prices. Just as surely, when a company overpays for repurchases, the continuing shareholders lose. At such times, gains flow only to the selling shareholders and to the friendly but expensive investment banker who recommended the foolish purchases.
It's obviously, as long as you're telling the truth to your shareholders about what's going on so that you aren't manipulating the stock downward or something, when a stock can be bought well below its business value, that probably is the best use of cash. It's something the Washington Post did on a huge scale back in the 1970s. And that was the reason a very significant percentage of companies bought stock back in the past, because they actually thought it was selling for less than it was worth. Like I say, that can be abused if you do various things to bury your stock in one way or another. But that wasn't the usual case.
Number three, better metrics. Stock buybacks reduce the number of shares outstanding, which can increase earnings per share (EPS) without changing the company's total earnings. This makes the company appear more profitable. However, it's essential to know that while EPS may rise, the company's overall value decreases by the value of the repurchased shares. Number four, share buybacks can offer tax advantages compared to dividends. Let's say you bought 100 shares of a company at $100 per share, and the company later announced a buyback program at $105 per share. If you sell your shares back to the company with a capital gain of $500, if you've held the stock for over a year before selling, in the US, you're more likely to fall into the 15% long-term capital gain tax bracket based on your income. You would owe $75 in taxes on that gain. In Australia, you will get 50% of the capital gain before adding to your taxable income that year. Those who don't sell are left with an unrealized capital gain. Let's assume the stock price will organically rise due to the reduction of the outstanding shares in the market, deferring any tax to the future until the shares are sold. Tax deferral is valuable to investors because money has time value. It leaves more money to be reinvested today, compounding returns over time. Let's compare the buyback scenario to dividends. Say you are about to receive the same amount, $500 as a dividend, and this $500 will be subject to ordinary income tax on the total amount. Depending on your tax bracket, that typically means paying a higher rate than the capital gain tax. This can be particularly beneficial if you believe in the company's long-term prospects and prefer to hold on to your shares. While investors often favor buybacks, they can have downsides, and sometimes the true purpose behind buybacks might not be entirely genuine. For example, companies might repurchase shares to artificially inflate share prices because executive compensation is often tied to earnings metrics. This can give a short-term boost to share prices. If buybacks are financed with debt, it can be even more risky. Or a buyback might indicate that the company has run out of other investment ideas to increase the company's intrinsic value. So how can investors decide whether to participate in a buyback program? Number one, assess the company's future performance. If you believe the company's shares are undervalued and expect strong future growth, holding on to your shares could offer greater long-term gains than selling them back. Additionally, you can defer capital gains tax to the future. If you're doubtful about the company's future performance or think the market has already fully valued the shares, participating in the buyback might be a prudent choice. Second step, evaluate the offer price. Assess whether the company is overpaying for the repurchases. If the buyback price is significantly above the intrinsic value, continuing shareholders could be hurt. You may want to get out. Speaking of intrinsic value, nowadays you don't need to hand calculate the intrinsic value. Seeking Alpha got them all ready for you. From the quantitative rating to the estimated target price from Wall Street analysts, you can use my link to get 20% discount on Seeking Alpha Premium with 7-day free trial. Step number 3, review tax implications. Evaluate the tax consequences of selling your shares back. Depending on your financial situation, the net benefit of participating in buyback might or might not be worth it. Consider how the capital gains tax and potential benefits align with your overall financial goals. While the stock price might temporarily rise after a buyback, returns are not guaranteed. Make informed decisions based on your perspective on the company's future, the offer price, and the tax implications. Type in buyback in the comments area so that I know you're one of the few viewers watched to the end. My name is Irene. I'll see you next week. Bye.